Hey, it's Patrick Moore with Ironclad Wealth Management here, and this month's video is going to be on how you can turn a tax triple play. As always, when I'm talking about this, I like to talk about tax decisions that will save you not thousands of dollars, but tens of thousands of dollars. And if it was a little small one, I probably wouldn't ask you to take a few minutes and spend some time with me. Now, when I say triple play, what I'm going to talk about today is something where you make one small tax decision and it has a trickle down, a knock on, kind of a flow through effect on so many different areas of your life and tax code. So today I'm going to show you how one small decision, and actually it's a counterintuitive decision that you would probably think your taxes would go up by doing, can save you this much money. Now, before we get started, we do have to do the fun part. And by fun part, I mean the disclosures, okay? So I do want to say up front, this is not individualized tax advice, okay? This is going to be tax information that can help educate yourself and see if it makes sense for you individually. In no way, shape, or form am I just putting something out that says, hey, you need to do this, okay? Everybody is going to have an individual situation. So let's get started. If you're taking your time out of the day today, it probably means that you care about this, which puts you a step ahead of the competition. My goal is not to waste your time. We're only going to talk about actionable information for business owners. So if you're not a business owner, who's kind of the clientele that I work with, this stuff really won't apply to you. So have you ever said to yourself, I'm tired of paying more in taxes. I'm worried my tax bill is going to keep going up, and I don't even know where to start the pain. And if you've ever sent a text to your CPA saying, hey, is there anything we can do to lower my taxes? This place is for you, okay? Because there are people who are out there paying less. So if you take the time to go through this today, if you've asked any of these questions, we're going to provide you answers to questions that you didn't even know you were missing. And I do want to couch something right up front, and I want to say that, hey, I love working with CPAs, so in no way, shape, or form is what I am doing a replacement. It's just we do different things, okay? We complement your CPA strategy for you. We approach things from a different direction, and there's no competition. It's only teamwork, because some of these ideas will be things that they are talking about. Some of them will be things that they're not talking about. So who am I? Getting started. My name is Patrick Moore. So unfortunately, this is going to be something where a lot of my personal opinions go into this for you. So you do need to kind of get to know me a little bit. I'm a certified financial planner. I'm also an enrolled agent. So I am actually able to file taxes, but I don't do that. I like to do more of the tax planning, the forward-looking side, rather than the tax preparation, which is why I partner with your CPAs or other tax preparers. The problem is that very few people do both. And very early on, I realized it more from the financial advisor, financial planner side, is that they would just do things on their clients' taxes, and they would say, oh, we can't give tax advice. We only do financial advising. We only handle your investments. But I kind of thought that was a little bunk, because the reality is, if your advisor makes a decision for you, it's probably going to carry over and affect your taxes, and doesn't it make sense to bridge that gap and have both of them speak with each other? And the reason I came to that conclusion is I'm what's called a fiduciary. And that means I'm legally required to act in my client's best interest over my own. And I thought, if I make a decision for a client and I don't know that tax impact, is that really acting in your best interest? So that's where all of this came from, and that's going to underpin everything that we talk about today. And when I talk about my tax philosophy that's going to underpin this discussion, there's really three rules that I live by. The first is that I believe in proactive planning. If it's already happened, it's too late to plan for it. If it's the end of the tax year and we're getting, and you're trying to scramble and find something to do before April, you might be able to do some things. But if you had planned in the previous year, will you have had better results? I can unequivocally say yes. So that's rule one. And don't get discouraged if it's, you're kind of looking at that April deadline right now, depending on when you watch this video. It's just a general rule. Second is I want to pay the lowest amount of taxes over my lifetime that's possible. What does that mean? It means there may be a strategy out there that will save you money this year, but will cost you more money down the road. And it's my job to equalize that and get it the lowest over your lifetime. That may mean paying some taxes today at the cost of not paying them tomorrow. And then finally, I want to do it completely legally. Nobody wants to live with a cloud over their shoulders, and I sure don't want to do that either. And you may be saying to yourself, hey, who is this young guy giving me advice? How could he possibly know what to do? You could even be saying, who the hell is this young guy giving me advice? And hey, I can't really deny it. I got a bit of a baby face. I am young, but I've already been doing this for, 7 years now. And my clients have seen real results. I don't think I'm allowed to talk about specific results because it's considered promissory. But things have been very good, and this is tinged by, clients' experiences. The real question is, how can you afford not to listen? So if you stick with me today, I'm going to share a copy of my ebook that's helping business owners achieve financial freedom. It goes over taxes, it goes over insurance and kind of protecting your business, and it goes over investments. And if you'd like, you will be able to schedule a free strategy session for me where there's no cost obligation. You basically say, hey, Patrick, I like what you said, and I want to chat about it and see if there's anything we can do. So I'm not going to turn this into a promo. My goal is to always be educational, but if you want to, it's out there. So the problem we're facing today is that essentially the tax code is complicated. And what do we need to do to turn that triple play and take advantage of it? Well, there's 3 things that are inhibiting us from taking control of your own tax situation. First is that the tax code is complicated. That's just the reality. The second is that because it's complicated, it favors the big guys. And the reason it's complicated is that it's constantly changing, okay? So as we look at this, the tax code was not written in a day. The last bill that was passed, whether it was the CARES Act or the really large kind of tax reform bill in 2017, the Tax Cuts and Jobs Act, they're just additions to the base code. In some ways, they'll replace things, in other ways, they won't. But the TCJA of 2017 was only 185 pages long. And I say only because you probably think, a government bill, that's probably pretty short. And that's nice until you go in and you realize the Treasury regulations clarifying the bill were over 1,000 pages long in addition to that 185. And all of a sudden, okay, that makes sense. And I'm sure it's still being clarified and they're being added from when I made this slide. So who knows the answers to these problems? And the reality is you probably know. It's corporate America, it's Amazon, it's Apple, whoever it may be. They're the ones who have the armies of lawyers and tax accountants who are going to be able to kind of get into the weeds here and make these things happen. And to me, that really kind of sits raw with me because I think everybody should kind of have that equal opportunity once you get into these laws to make the most of, what you can for what you earn. So what this looks like is in 2019, so obviously this is a few years old now, Amazon paid $162 million in taxes, which sounds like a lot until you realize that they earned $13.2 billion in taxes, which means their tax rate is 1.2%. And if we look at 2018, you'll see this isn't like an Amazon or kind of tech specific phenomenon. Delta, Chevron, GM, EOG Resources is a gas company. These are not things that people are unaware of. It's just how are they doing this, right? And if you look at this, I think there's one major thing that they're doing a little bit differently we'll get to in a minute. But like I said, the thing that really kind of grinds my gears is the fact that the people on the call today may not have, or watching this video, may not have paid more than $162 million in taxes. You probably wouldn't be watching this if you had. But they probably paid a higher percentage in taxes. You probably paid higher than 1.2% on your income in taxes. And that's something I can't say that, watching this video will get you to 1.2%, but we sure can make it a lot more competitive and help you save and keep more of what you earn. So how do we do that? Well, it all comes down to what I call proactive planning, which is rule 1 of tax planning. Do you think Amazon just kind of sat down in February or March was like, all right, what are we going to do? How are we going to save taxes this April? Not a chance in hell, okay? What they did is, along with their business plan, their marketing plan, their financial plan, right, their financial projections, they sat down and said, okay, if we do this, what can we do to lower our taxes along the way? and it works pretty well. The reality is just like there's programs for, kind of larger corporations, the S&P 500 to lower their taxes, there are also programs that are out there that business owners and small business owners can use to lower their taxes today as well. So what we're going to talk about is 4 different strategies today that are all affected by one decision that you make. The first is we're going to talk about how to set up your W-2. We're going to talk about the qualified business income deduction. We're going to talk about retirement plans. And we're going to talk about a bonus strategy that I bet you weren't going to think about today, but I love incorporating in this because it's just one of those things that's in the background you don't think of, but if you do things a certain way, you can save a lot of money or make a lot of money. So, what is proactive tax planning? Proactive tax planning starts before the end of the year. It's legal, okay? And it emphasizes lifetime savings over short-term savings. So when you plan proactively, one decision can impact multiple areas of the tax code because of how complex and arcane it is, and they can compound each other either negatively, because don't get me wrong, if you make one tax decision, it may not have another positive one. It may be a negative effect, or it could be positive, and that's what we're going to talk about today. So imagine for a moment that you are Joe and Josephine Sample. Okay, you're married, you've got 2 kids, you're 45, you're running a business with no employees, you're earning $500,000 a year. I've made this kind of very simple, right? But looking at this is going to be what we use as our baseline, because you always want to look at a baseline to decide if a tax decision is right for you. So how many people have heard the advice? You're like, okay, they're making $500,000. You know what we need to do? We need to start an S-Corp, okay? How many people, I bet if we were in a room and I could see everyone and I said, how many people have heard the advice, you need to start an S-Corp because it's going to save you money on taxes? I would bet every hand in the room would go up. And that's not necessarily bad advice, because here's how it works, okay? This is probably the most common strategy that I hear for business owners when we talk about, planning. The reason that an S-Corp saves you money on taxes is that your income gets split into 2 segments, okay? When you're an LLC, all of your income goes in one segment, and that's all subject to FICA taxes, or those self-employment taxes that pay into Medicare and Social Security. When you set up an S-Corp, let's look on the left-hand side here. Your W-2, if you make $500,000, is set at $60,000. It's going to be subject to federal income taxes, state income taxes, and those FICA taxes, as well as it's not going to get what's called a QBI deduction, which came out in 2017. Now, what if we contrast this to the profit side, which is going to be your business income, $440,000, subject to federal and state income, but not subject to FICA taxes. And what this means is that on amounts up to your first $160,000 earned, if it's not set up as a W-2, you save about 15.3% on your FICA taxes, and any amount over $160,000 is about 2.9%. So if I had to put this in the simplest way possible, the reason that people get recommended to set up an S-Corp is that you can lower your W-2 relative to your business profits, and you save about 15.3% on that money up to $160,000 and about 3% thereafter, which seems straightforward. Low W-2 good, high W-2 bad. That's kind of what it boils down to. But my question would be, is that truly a proactive tax plan? Is that looking at every knock-on impact, and we're disregarding some of the regulations around W-2, around reasonable compensation, but is that proactive? I would lean towards no, okay? I would lean towards that being one decision made to save taxes, and specifically your FICA taxes, because it saves about 15% on that first $160,000. So let's talk about how we can make this a more proactive plan where we analyze all the disparate impacts on Joe and Josephine's life. So let's look at their income here. They're making $500,000. They've set their W-2 at $60,000 just because they're like, hey, everybody else is doing it, right? They're maxing out a SEP IRA, okay, probably the most common, easiest to set up retirement plan for a business owner. Their second spouse stays at home, whichever one that may be. They live in Georgia. I'm from Atlanta, so, sorry, it's kind of partial to the Georgia. They're married. They have 2 kids. These facts will work for any state, but I'm using Georgia today. So if we look at this, and we're looking at this S-Corp owner through my tax software, I've made very minimal adjustments, minimum assumptions. This is just using that SEP IRA is really the only kind of adjustment. They would pay about $126,000 in taxes this year. If you look at that, their FICA taxes are about $9,000 of that. So when we're looking at decisions, that's the baseline that we look at, okay? So, what can a single strategy do? So what we're going to do is we're going to do those 4 strategies we talked about, and we're going to say, all right, what does each impact do if we were to just do it on its own? And then at the end, I'm going to show you what it looks like when you consider them all together. All right, so the first thing we're going to do is we are going to look at changing your W-2, okay? Now, one thing you'll note is if we look at our baseline right here in the chart, the total taxes went from $126,000 to $133,000, and that's because I'm excluding the SEP IRA. So there's no retirement plans. We're purely looking at the W-2. So remember, the reason that they have their W-2 set at $60,000 is that it excludes a large amount of FICA taxes through the business profits channel. Now, I alluded to it earlier, but there are regulations around what you need to set your W-2 at. And if you set your W-2 at something artificially low, like $24,000, $36,000, and you're making $1 million a year, you may want to review that to make sure you're in compliance, because that's going to be something they're going to zero in on if you do get audited. So let's say we go around and we're like, all right, well, let's raise our W-2. And when I was talking about that counterintuitive decision earlier that's going to have 4 knock-on effects, let me boil it down. I'll hold the suspense. We're going to show you how raising your W-2, even though it increases your FICA taxes, can save you money on taxes. So let's look at this, and let's say that your W-2 goes from $60,000 to $120,000. It actually lowers your taxes by about $2,200 a year. I know, I promised large amounts of savings. That's not it, but it's a whopping $2,200 just by basically changing one small thing. Now, what you'll notice is that the FICA taxes, because your W-2 doubled, also doubled. But if you look, your federal income taxes went down a pretty significant amount, which is what makes that difference. So how did that happen? We're going to talk about it in just a moment. But essentially, when people kind of say, hey, set up an S-Corp, go in here with your W-2 versus your business profits and make that W-2 really low, that's an example of a tax idea. It's not an example of a tax plan. Okay, so the second thing I want to go over is something called the qualified business income deduction, okay? This is the reason that federal income tax went down. The qualified business income deduction basically says that on your business income, you can get a 20% deduction if you meet certain criteria, okay? And if you look at it, I've got a very simple chart on the left. From 0 to about $340,000, and this is married filing joint numbers, okay? So it's about half if you're single. They say you can get that 20% deduction, really no questions asked. Once you get from $340,000 to $440,000, it starts phasing out, and over $440,000, you're limited to your deduction by half of your W-2 wages paid, which would include employees if you have employees, or your own if you're a corporation. Now, the other note is that there are certain types of businesses that are excluded completely from the QBI. If you fall in that category, this really doesn't apply to you, but this applies to the vast majority of businesses. So the reason that those federal taxes went down, and this is strategy number 2, which is still affected by just changing your W-2, so we really haven't done anything else, is increasing your W-2 from $60,000 to $120,000, increased your FICA taxes by 2 times, but it also increased your QBI by 2 times at the very least. So that's what the QBI deduction is, and we're talking about all these different ways things impact. This is strategy number 2 by only making that one change, all right? Now the next one we're going to talk about is your retirement plan. This one requires a slightly different change, But the reason this is so important is that when you're an S Corp, your maximum retirement plan deduction is not based off of your business profits when you're in a SEP IRA. It's actually based off of your W-2. So remember how somehow everything flows through? Well, your W-2 not only affected your FICA taxes, it affected your QBI deduction, and it also affects the maximum amount you can put in a retirement plan. So as we look at this, the calculation for an S Corp owner is it's going to be you can contribute up to 25% of your W-2 salary into a SEP IRA. Okay? So if we look at the base scenario, $500,000 with a $60,000 W-2, it's $15,000 in maximum contributions, which gets you back to that 126 number we looked at earlier. Now let's look at the next portion, where we increase our W-2 to $120,000 and we still max out our SEP IRA. Your maximum contribution goes from $15,000 to $30,000, which lowers your federal taxes by a total of $14,000 against our base scenario, increases your FICA taxes by $9,000, saves you a little bit on state, and it gives you a total reduction in taxes of just south of $7,000. Which we're talking about, hey, that's another good thing, right? It's another single strategy that can save you money, but it's going to save you more money if your W-2 is higher within certain limits, because we've got to think about all of those other effects. And we'll talk about it in a moment, but there's also other retirement plans out there that can change you positively as well. So this is the third thing, that changing your W-2 in a way that you think would make your taxes go up could make your taxes go down. And then the final thing that I am going to show you, and this is strategy number 4, okay? This is the one that I told you probably weren't going to think about as a tax saving or essentially a way to save or make money through taxes, is through your Social Security benefit, all right? The reason I love this one is because a lot of times I hear doom and gloom. They're like, Social Security's not going to be there for me. Social Security's going to go bankrupt, blah, 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 whatever that may be, okay? But the way I look at it, and I'll tell you in a moment, is really you have a choice. You can choose where to pay your taxes. Would you choose to pay into Social Security and have that directly connected to your Social Security benefit, or would you prefer to put it in pot 2, your general federal income taxes, where they go to pay the military, the IRS, Congress, the president, just the general federal government? You really, in this scenario, have a choice. You're still paying about the same amount in taxes, but you can say, hey, do I want to put this in Social Security, which has a tangible direct benefit to me, or do I want to put it to the general federal government? My opinion is that I'd like it to pay into my own Social Security benefit, so when I retire, it's higher than it otherwise would be. Now, like I mentioned earlier, you're saying, doom, gloom, I don't think Social Security is going to be there. It'll probably be there in some form. The last projection I saw said that is 2032 or 2034. They were saying that at the current projections, Social Security wouldn't run out of money, but it would start going into a shortfall, which would not mean that Social Security would go to zero. It would go to, I think your benefits would reduce by about 25% or so, and it wouldn't matter which way you did this. Now, I'm of the opinion that whichever congressional, party or president allows that to happen is probably going to face some pretty negative ramifications, because the people who vote in this country are retirees. So I'll believe that when I see it. I'm more of the opinion they're going to make some tweaks to the calculation to keep Social Security going. So with that being my thought process, because remember, this is all, kind of couched in my opinions, let's see how changing your W-2 affects you personally with strategy number 4. So I said, this person is 45, they've been working in college since they were 22, and your Social Security benefit is based off your highest 35 years of earnings. If this person if Joe or Josephine keeps their earnings, their W-2, because remember the business profits, even though they're making $500,000, doesn't pay into Social Security at all. That's the negative side effect of saving on those taxes. If they keep it at $60,000, their Social Security benefits, when they are, I think I did it at 67, is $2,520 a month for the rest of their life, which is great, okay? The present value of those benefits is assuming that Joe lives for 20 years and gets could have earned a 5% interest rate, is about $381,000 and change. But let's say we increase the W-2, like we said, which should have been a negative impact on your taxes. Well, the first 22 years he was working, I still had him coded in there at $60,000 of earnings. But for the remaining 22 years until 67 that he's working, I bumped his income from $60,000 to $120,000, which means not only is he paying more taxes, but he's paying more into Social Security. That has an almost 20% increase on his lifetime Social Security benefits, or her lifetime Social Security benefits, which increases their monthly payment from $2,520 a month to $2,981 a month, or a $461 a month increase for life. Which, if you take a present value, which I think is easier to value just on a snapshot because you don't really know how long that'll be, that is a almost $70,000 increase in benefits. When I told you we weren't going to talk about something small, that is worth about $70,000 to this couple today to do. And we're not even talking about the fact that they can do this while saving money on taxes. So when I say that everything is interconnected, this is what I mean. And this is where I get excited, right? Because you can make one small change, have 3 positive impacts. So that's what the proactive combination means. If we summarize everything, we increase the W-2 to 120. That's the one change we really made. Your QBI, because you're in the phase out, went from $36,000 to $64,000, almost doubled. Your maximum SEP deferral doubled. Your Social Security benefits increased by almost $70,000, and your taxes paid decreased by $6,640. So the net benefit to these clients by making this one small change is about $75,000. We didn't have to go chase a hot investment. We didn't have to grow your business at all. What we did is we made one small change based on that fact pattern and had a huge increase in lifetime benefits. So to summarize, we had one action, increase your W-2, which had 4 outcomes. Increase your QBI deduction, increase your QBI deduction by reducing the phase out, increases your retirement plan deduction, and increases your future Social Security benefits. And this is just the tip of the iceberg, okay? There are hundreds of strategies out there that you can combine to provide multiplicative effects. And I would counsel you not to just chase that hot idea and say, oh, this sounds like a great idea, right? No. Take a moment, see how it impacts your entire picture, and maybe 1 or 2 or 3 strategies can combine to provide 3.5 outcomes. There's even some ways we can improve on what I just showed you, but for the sake of time, I had to keep it reasonable. I didn't want to, make you incredulous. If you're an LLC or C Corp, some of these may not work exactly the same, but the same concept applies. Sit down, analyze things proactively, and turn that tax triple play. So if you plan ahead, you can increase your effectiveness. So just to recap, what did we learn today? We learned how our W-2 has multiple impacts across our lives. Second, we learned how to time and combine strategies to provide, rather than 1 + 1 = 2, maybe it's 1 + 1 = 4. And then third, we learned that we need to get started before the end of the year. So I have 4 simple questions for you, and that is: 1, are your taxes going up? 2, is it important for you to start planning now if the answer to number 1 is yes? 3, are combining strategies rather than selecting them one by one the better path forward? And 4, and most importantly, when was the last time that somebody called you with a proactive tax strategy that will save you money on taxes? If the answer is that it hasn't happened recently, it's something that I think you need to sit down and think about. And I say that it's up to you. There's really a few different choices you have, and really the main ones are, hey, you can do this on your own, kind of take the information, analyze it on your own, use your own software, or secondly, you can get help with your current tax professional and kind of make this happen, or you could work with me to make this happen because I am bringing on new clients at this time. I guess there's also a third option, right? You could technically not do anything and continue to pay thousands and thousands of dollars in taxes you don't have to pay. But because you were on this call today, I doubt that's going to be the option. And remember, I think that's the option where people say, hey, yeah, I don't want to do anything because I'm not sure this is legal. Everything I just did was very simple, very straightforward, right in the letter of the law. And I want you to remember that, to save money in taxes, it doesn't have to be this fancy, Cayman Islands, blah, blah trust, right? You can do it with very simple tools. So my offer to you is that we do incorporate about 60 plus planning strategies into our planning process, and we're constantly adding new ones. This is just one combination of those. For everyone on the call, once again, there is a free strategy session available to review your most pressing questions at no cost or obligation. Typically what I do is a 15-minute phone call just to learn a little bit more and see if I can help at all, because sometimes I can't. I'm not afraid to tell you that so you don't waste an hour of your life. But if it does make sense, we can do a 1-hour review. So with that being said, I hope you enjoyed this today. I hope it helped, and y'all have a great rest of the day.